Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 3rd, 2018 edition of Market Outlook. So, very interesting week. Over the last couple days, you certainly had some extreme choppiness, especially in the S&P. It was a little bit cleaner in the leading indices. IWM and the Qs both resolved themselves nicely to the upside for the week. We closed on all-time new highs in the IWM. So as you can see here, we actually paused with an inside day pattern, basically touching or just about touching all-time new highs on Friday, not quite making it and setting up that inside day pattern. So again, a move above 164.50 or so would resolve this inside day pattern again to the upside and mean more acceleration. Now the Qs also put in a stellar day on Friday. Good movement for the week, up 1.55% and just fractions away, or I would say less than 1% from all-time closing high. So the Qs, right? Technology and internet-based stocks really on fire, led by semiconductors. The other thing here, of course, is small cap domestic stocks doing extremely well. In fact, that is closed on all-time highs. So on a relative basis, IWM continues its lead. The lagger, of course, is the Dow. It has the most sensitivity to issues around global trade. And as you can see, it actually closed fairly weak. It was actually down on the week. And that close under this declining 10-day moving average, not so convincing. Now, we are in a bull phase in all of these indices across the board. And again, in the S&P, we had this nasty fake out earlier this week, and it ended up being a true head fake and resolving itself to the upside. So net, with all of the mixed news, tariffs, the market has been able to shrug off lots of bad news, and net, with the leadership with the Qs and the IWM, things do look poised to move further to the upside. Earlier in the week, we had a situation on that sell-off where things really started to look iffy. And in fact, at one point, as you can see right here, right, the red line here, which is the closing basis on the ratio between the S&P and utilities, utilities were actually looking stronger on a monthly basis. However, on a 6-month basis, we basically came down and touched this rising 6-month ratio moving average, and that was a positive sign. And guess what? By Friday, right, things moved back into risk-on bullish mode. Utilities, again, losing ground, closing basically under the 50-day moving average, again, putting it in a bear phase. While, of course, we got a pretty good close, we really want to clear this resistance level here. And in essence, we want to get a move above the 274 level in the S&P, and that would confirm a breakout here to the upside. So net, nice improvement in risk-on indicators. Now, let's take a look at a few more key ratios, and you're going to see improvements there as well. So compared to where we were earlier in the week on the sell-off, it looked like we actually might have gone into a sell mode, but we didn't stay there long enough, and based on our actual model in alpha rotation, we stayed long, which proved to be, at this point, a good move. So again, wood versus gold, commodities definitely improving. That's a good sign. Gold, more of a anxiety play on global tensions, lost ground, versus wood. That's a positive and a risk on. And again, you can see that confirmed here with the S&P versus gold. Again, that has never been in question for several months now, and that is in gear risk on. The biggest concern is in high yield debt versus the recent strength in U.S. bonds. That has definitely put the market on notice, right? So some weakness there. Now, also of interest, you can see we had some extreme weakness. You had a big rally in the bonds. You had that sell-off that sort of generated concern and a red flag, but things definitely improved, although this is still putting up a cautionary tone, but with any further upside movement, that would be resolved. So at the moment, we're more favorable in terms of risk-on relationships, although things, even with this up move, did weaken a bit from the past several weeks. Okay, so the concern that we had mentioned last week was that these indices just were not picking up very much volume, with one exception was the Russell. Now, what's interesting is even though the Russell was up decent on the week, it wasn't the leader, the NASDAQ was, it lost some of its accumulation days that it had gained over the last few weeks. So in terms of volume, there's not excessive volume here, and in fact, it's sort of in a neutral zone. One thing that did improve quite a bit was the NASDAQ 100. And again, the two lagging indices, the Dow and the S&P, still have 4 distribution days. There hasn't been big institutional volume following this improvement in the market. So it's very possible that we could get a further spurt, clear out any weak shorts, and possibly head for a correction after it basically forces those weak hands out of the market. On a more positive note, what has occurred is speculative sectors definitely were the strongest this week. So if you take a look, semiconductors, right, even though it's not the strongest out of the bunch over the past 6 months, it lost a lot of headway, it did have a very, very strong week, right? Over the last 5 days, semis were up over 2%, well outperforming the S&P. So there you have it. The other one that did pretty well also was, of course, the technology sector. That was up 1.8% for the week. So again, speculative sectors definitely did well, and weaker ones, right? Utilities, that's a positive sign. The other thing that was weak, consumer staples. So again, the focus here on speculative sectors still showing strength is a positive. Looking at what's hot and what's not, to me, the biggest and most concerning point is that volatility, VXX, even though it lost quite a bit on Friday, 4%, look, the 5-day performance shows an increase in price. So up 4.38% in volatility in a week where we had positive movement is very, very interesting and unusual. So again, if this is the harbinger, then you could expect, again, another choppy and a reversal. Now, this could also be just an anomaly and in effect moving into this distribution mode. This could continue on the downside. That would be positive for the overall market. So again, as you can see, utilities moving into a bearish phase. That is definitely more of a risk-on type of indication. So there you have it. A very, very interesting mixed read. And of course, the biggest factor was that U.S. oil under pressure. That has been or was the strongest by a wide margin in terms of any sector or segment of the global economy. And that definitely went on pause this week, down over 7% over the last 5 days. So that's really 5 days worth of action. And considering that we were off, that also includes last Friday as well. So there you have it. Those are the big features here. It's not exactly straightforward or clear which one is going to lead here. Is oil going to come back, firm up? Is this pop in volatility for the week in the face of strong action a harbinger? But net, if I add all of the factors together, price is the final arbiter, and that definitely across the core indices looks like it's much, much more in favor of a continued bullish move in the equities market. Okay, so that wraps up for this week. Goodbye for now, and see you next week. And most of all, good luck with your trading.